What is the cash value of a whole life insurance policy? Cash value insurance is the answer to the challenge of providing a lifetime of life insurance but at a reasonable cost. The key problem here is that as we age, our chances of dying are becoming higher and higher, and at some point the cost to insure us would be too high for us to afford it. Follow below. First, there was term insurance in its simplest form. You paid the least amount of premium based on your current age. Say somebody was age 30, purchased that simple term insurance and paid $10 for it. After a year, the insurance company asked that person if they wanted to keep it, and if so, then because now their age was 31, so the insurance would get somewhat more expensive due to age and would cost $11. And the process would continue. At age 55 the insurance would cost $35, at age 60 it would cost $50. The closer we get to certain age, the higher the chance that the insurance company might pay the death benefit. Now the person was age 70 and the insurance would increase to $115. The person said in response, "But I cannot pay it, it is too much." So he dropped that insurance because it was no longer affordable, died 6 years later, and no death benefit was paid. All the premiums paid before did stay with the insurance company, because they were paid for all the years when he was younger. Well, that did not go well, because a good life insurance is such that it pays when we die. What's the benefit of keeping life insurance for a while if at the end we drop it and lose all the premiums for nothing? So they thought about it. How can we offer insurance that would not become so expensive later on that people just cannot afford it anymore? And they came up with an idea of premium prepayment. They said, if for a 30-year-old the premium was $10 but for a 70-year-old it was $115, why don't we ask people to be insured to pay a little bit more in the early years, take that extra overpayment in the early years and invest it on the life insurance policy, make that money grow. Let's call that extra premium fund a cash value. Later on, when the person gets much older and the cost of insurance is so high, then we will use that extra accumulated money from cash value to pay some of that high insurance cost and keep the premium level. So they said to the 30-year-old man, "We will give you insurance that will not go to $115 at age 70. And we will not increase the premium each year. Instead, we will ask you to pay a higher premium from day one." At age 30 the term insurance was asking for $10, but then the premium would increase and increase. Here we will ask you to pay $45. From that $45 we will deduct $10 for insurance and keep the rest of it, $35, on the policy. And the next year you still will pay $45, we will deduct $11 as the cost for a 31-year-old, and we put the difference to cash value. We also will add interest to the cash value so it grows. And we will do it every year. When you will be age 60, the cost of insurance will be $50 but you will only pay the same $45 as always, we will take that $45 of your premium and then deduct the missing $5 from your cash value. When you will be age 70 and the insurance cost will be $115, you still will pay only $45, we will deduct the difference from cash value. This way you can keep your insurance for the rest of your life, and the policy will pay death benefit when you die. You pay the level premium of $45 on time, and we guarantee that the policy will pay when you die. The person then asked, "But what if later on my spouse dies, my kids are grown and I do not need my life insurance anymore?" Well, the insurance company said, "Then you can decide to drop your insurance and we will get you back your cash value balance, whatever it is at the time." The person then asked, "But what if I cannot pay later on because I lost my job and need time to find a new one? Can I skip the premium and still keep my insurance because you have my cash value there?" Yes, they said, as long as there is enough of cash value left in the policy to cover cost of insurance, your policy will be fine. We will just deduct the cost of insurance for as long as there is money left in cash value. The USP of whole life insurance is to solve the problems arising with pure term insurance. The biggest concern of pure term life insurance is that it is purchased for a stated period of time. If the insured dies after the term ends, the beneficiary does not get the premiums and does not receive the death benefit because the insured did not die during the term. These policies need to be renewed year on year till the opted years of coverage ends. The received premium is allotted to pay the mortality charge to meet the cost of pure term insurance, and the balance of which go into the cash value account. The insurance company invests the cash value account money for the owner as per the respective country's government directives or the regulatory guidelines in the interest of customers. Mostly the investments go into highly rated bonds, debt funds, mortgages. Historically, the average gross return of these investments has been between 5% and 6%. While you cannot depend on future returns to be the same as past returns, this average may give you an idea of what the cash value account may yield. The insurance company keeps some of that return as a management fee. The cash value account belongs to the owner of the policy. The owner can borrow it from the policy or withdraw it entirely, which the insurance company charges a fee for both options. If the owner borrows from the cash value account, the insurance company will treat it as a loan, and charge the owner interest. Therefore, if the owner takes a loan, he or she will owe the premiums, plus the interest on the loan until the loan is repaid. If the insured dies while there is a loan on the cash value account, the death benefit will be paid minus the loan and any interest still owed. If the owner withdraws the money, he or she will owe income taxes if the amount received is greater than the premiums paid, and the policy will be cancelled. Remember, the beneficiary will not owe income taxes on the death benefit.